Welcome, members and guests, to the Virtual Investment Club International meeting. We are a better investing model club open to the public. Our meetings are held on the third Monday of each month at this time, and the exception being December, when we meet on the second Monday of the month because of the Christmas break. All our meetings and stock studies are held online, allowing us to have members from the US and around the world, including Canada and China. Guests as observers will be muted during the meeting and will have an opportunity for questions and comments once the meeting ends. Any companies mentioned today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. And this meeting may mention products or services that are not endorsed by Better Investing or this club. The views expressed of our members are those of the members and do not necessarily represent those of Better Investing. And please note that this meeting is being recorded and will be posted on our YouTube channel for future use. And with that, I'm going to pass it over to Matt to go through the agenda. Is Matt here?
Yep. Hey, Haney.
Oh,
sorry.
Okay. Hi, Matt.
Sorry, I couldn't get the mute off there. Are you passing it to me or? Oh, it's just pulled up. Okay. Sorry, I wasn't looking at the screen. Yeah, so we're just gonna do the treasurer's report really quick. Education topic is gonna be you and Bernard. You're gonna do the My iClub. Sorry, I thought that was in there. And then he's gonna do the PEG ratio. And then Tom's gonna review Skyworks annual report, and I'll do Disney. And then if there's time, we can do AQN and anything else that people want to do. Just making sure we reserve 15 minutes at the end to discuss any buys and sells. Yeah, so that's it. So with that, treasurer's report.
Okay, I'm going to make Tom presenter. Okay, Tom, I made you presenter.
Okay. Now can you hear me all right? Hello, can everybody hear me today?
You could talk a little bit louder, Tom.
Okay. Okay, I got a new computer here and I'm trying to figure everything out. I apologize. I don't remember. Did we buy or sell anything last month?
We did. We bought, wait, last month, CSIQ, you had it. Oh, wait, CSIQ 2 months ago, isn't it? Last month was a quarterly report, right?
Yeah, I don't think we bought or sold anything last month.
Yeah.
No.
No.
Okay, so because I assumed we didn't do any transactions, so I guess we're current. I did add $1,000 cash, so we now have 6,800 in cash. This is the portfolio, and I don't know that things have really changed since last month. I guess there's probably been some market fluctuations. I don't know exactly what they are.
Early on, Henny was showing me there's a sold performance. He was showing me on the left navigation under going down. He was showing me that, what if the ones that we sold, if we capped how it performed. I thought it was pretty cool.
Yeah,
That's under reports. Yeah.
Yeah, reports and then sold securities.
Right. So basically, this report shows the securities that we sold. The first column says first purchase. That's when we bought it. How much we bought it for. So we bought $2,000, and then we sold it on the September 17th, 2019, Bank of the Ozarks. We made, or what we got was 1,000 roughly, and 176. So we lost 41%. But since we sold it, it's gone up by 30%. And then the report also compares the performance of two benchmarks. One is the Vanguard Total Stock Market, and the other is the Vanguard 500. Both of those have gone up about 19%, it looks like here, but Bank of the Ozarks had gone up 30% since we sold it. So this report is good because it tells us if we made the right decision or not. The other thing is, if you can just click on the notes part there, Jay.
Mm-hmm.
No, I have the screen. Click on this note. Where
Or
is it?
Tom. Sorry,
Oh,
Tom.
was that it?
Just click on that. So you can put notes in as well when we sell to say why we sold it, and that gives an indication of some of the thinking at the time. So I think this is a pretty handy report. But we were just talking before the meeting. We also have the spreadsheet that on our Google Drive, and it's probably not a bad idea to have that redundancy, update the spreadsheet and the sold securities report.
Okay.
So,
Now, I just want to, while we're on this, I just want to bring something to everyone's attention. So I can't remember. It's not on this. This report is for a certain time period. If you go down to the bottom, you can change the time period of the report. But if you recall, we had bought High Crush Partners at one time, I think, and I can't remember how much we bought it for. It went from a high of $70, and that was about 5 years ago, and today it's trading at 69 cents.
I
So
know.
we sold that
That's
right at the right
crazy.
time. Yeah.
So how come not showing? Can you say 2017, 2016?
Just
Right.
change the date.
do that.
Yeah, I want to see. Why is not showing?
No, just wait. So
Okay.
pick,
I thought you already did.
So,
and then hit submit. After you change the date, you have to hit submit. Click on a date. Click on a
Yeah, go ahead, submit.
submit. Yeah, there it is. So
It went up
we
to
made
70.
we
Oh,
made
no.
59% on it, and then it went down by 80% since we sold it. So that was a good decision.
Actually, can we show since 2016, May 2016 to 2019? I'm just curious. You can type it. Just say 0520 /20 2016 and then submit. So based on this, overall, we are doing pretty good. Only Fizz and Tencent and High Crush, only three, right?
Yeah.
Descending,
Biogen.
basically.
We should have kept Biogen.
Oh, we should keep Biogen.
But then, I think I agree with Tom. Like they didn't have
At the time, yeah.
At the time, they didn't have anything in the pipeline, and I don't know if anything has changed, Tom. I think they're still. They just had some positive news, but
it's sort of up in the air. They released some news recently, but it's kind of a little bit sketchy. It's not definitive that this drug will be approved.
What about PetMed?
yeah, it's at the bottom, Joanne. I was just showing a graph of it. It went up and then it went down again. So I think it's kind of even. There was a spike and then it kind of reverted back to where we had bought it. So I think this is just showing that little spike, I think.
So it's not a snapshot of today, it's a snapshot of its the highest point, or where?
No, I think it's today. I think it's today.
Henny was saying that I was talking to him before the meeting, was saying, oh, we should hold a little bit longer. You know, we were impatient with, so we sold it right away, right? We only hold for what, 4 months? But he's saying that there is maybe 2 months later, it had a spike and then went down again. Basically, it's at the break-even point compare when we bought.
Yeah, if you want to give me the screen, I can show that graph again.
Okay.
Let me just get it here.
Okay.
I'll get it first, and yeah, here it is. Can you see my
Yes.
screen?
Mm-hmm.
Okay, Joanne, so I'm not sure where we bought it. I think we might have bought it April.
Mm-hmm.
So
Sold
sometime.
August.
Oh, okay. April would be here, right? And then it went down, and then it shot up, and then it's back up again, back down to this level. So if you look at this level here, it's about the same as when we bought sometime in, around here, March, April would be around here somewhere. So it's not, if you look at the whole time frame, it really just kind of bottomed out when it shot up and then reverted back to the normal level.
So we
anyways,
really wouldn't have made, what is it, 140% if we still held it.
In November, yes.
We would have?
yeah, because
We would
well,
have until November, right before November. Between
no,
maybe
because I think what it's saying is that, so we sold it in April, right? You said
we bought it in
Jay?
April, sold in
April,
August.
in August. So
Yeah.
from here, from August to here, yeah,
Oh,
it made 180%. But
okay.
if we had held it here, we would just be back to square one. So it's saying
just
from the
point,
time
we sold.
yeah, it's from the
Okay,
time that you sold it till.
Okay,
Yeah.
I see.
Yeah.
Thank you.
Okay.
Okay. Do you have anything else, Tom? Do I need to get back to your screen, or are you done?
Well, I don't have anything else unless anybody has questions.
I don't think we need to look at the pie chart again because we did not really buy, sell anything. You know, the
Yeah.
diversification.
Yeah, I agree.
Yeah. Okay. So do I give the screen back to Henny? And oh no,
No, yes, to you.
Okay. All right, to me. Okay, hold on. Okay, just a second. You can kick off.
Okay.
Okay.
So, all right. If you can, is that expanded? Yeah. Okay. And so we're going to talk today. Our education topic is really about the PEG ratio, and Bernard had graciously volunteered to do that. What I thought we would do is just because the PEG ratio depends on PE, I thought we'd do a little bit of review on the PE. So Jay, if you could go to slide number 2. Sorry, that's slide number 3. Go back one. Yeah. So I'm just going to talk about the PE ratio and the formula, then talk about trailing and forward PE. What does the PE ratio mean? What's a good PE ratio? Give some examples. Talk about industry PE ratios and some shortcomings, and then some alternatives, of which the PEG is one. And when we get to that part, I'll hand it over to Bernard. So next slide, please. So PE ratio is really just price earning. It's a relationship between the stock price and, sorry, I should apologize in advance. Some of this is going to be a little bit obvious, but there's a few subtleties that we should be aware of. So bear with me, and hopefully we'll all get a few, learn a few new things. So the PE ratio is the relationship between the stock price and the earnings. Sometimes it's called the price multiple or the earnings multiple, and it's used as a valuation tool. It's useful, but there's a number of limitations, and sometimes it's applied, incorrectly. So it can be used to compare a company's own pricing or PE against its historical record. It can be used to compare one company versus another, or you could actually use the PE ratio to look at the entire market at one point in time versus historical numbers. And in better investing, if we go to the next slide, Jay, please. In BI, we use on the second page, there's always we always have when we're doing a stock study, there's always a very sort of vigorous discussion about the PE ratio, and are we using the right number? Is it the right average, and so on. And so the reason, Bernardo and I thought we'd go through this is just to make sure that, we have some different perspective on how to use this ratio and how to apply it. So that's the main reason for this education topic. Next slide, please. So there are two PE ratios. One is the trailing, and the other is the forward PE ratio. The trailing PE ratio uses the earnings for the previous 12-month period and divided by the number of shares outstanding. Sorry, that's the earnings, and then the ratio is the current share price divided by the trailing 12-month earnings per share. So a couple of things to be aware of here. The earnings, a lot of companies are now reporting non-GAAP earnings, and so we have to make sure that we're being consistent when we're looking at the PE ratio. We're comparing the GAAP numbers, and then also making sure that we're taking the diluted shares outstanding. So that means sometimes companies will issue shares to executives, and that number is not always reflected in the shares outstanding. So it's the diluted number of shares, which includes any stock options or shares that have been gifted to executives. And that can be significant, and it can have a big impact because it'll make the EPS, the earnings per share, lower obviously if the denominator is higher.
Oh, and also companies are buying back shares.
That's right.
Their earnings per share because the share count is going down.
Exactly. Yeah, that's a good point. The other thing is that if a company is not making any money, if they don't have earnings or they're losing money, then you'll see they don't have a PE ratio because there's nothing to put in the denominator. And so that makes things a little bit difficult. The other thing is, the trailing PE ratio is popular because it's based on sort of data that's fixed. We already know the number of shares, we already know the earnings, but past performance doesn't always reflect what's going to happen in the future. And so when we look at the forward PE ratio, and I'll talk about that in a second, it's really important to try to figure out how is a company going to grow earnings? How are they going to grow sales? Are those numbers, do they make sense? And I'm trying to remember this one example, but Warren Buffett was talking about this, and somebody had projected sales for I think it was like a pizza company or something. And he just did a quick calculation, and he said based on that growth rate that they were projecting, every man, woman, and child in the United States would have to order 2 pizzas per year or something like that in order for them to have this the sales that these analysts were projecting. So sometimes it's very important not to take these numbers for granted, to actually just do a sanity check. So next slide, please, Jay. So the forward PE ratio is very similar, except in the earnings per share are the next 12 months of earnings. So it's basically what are the analysts saying? What's their best educated guess on the future earnings for the next 12 months? And then again, it's the number of shares outstanding, and that usually is the current shares outstanding. That's not forecast, unless if you read the 10K or the 10Q, if the board has authorized buying back shares, as Tom was saying, then you can take that into account. But usually, if you look at Yahoo Finance or any of those types of sites, CNBC and so on, they usually use the number of shares outstanding currently. So really the big difference is one, the trailing uses the last 12 months of earnings, and the forward uses the earnings for the next 12 months. And next slide, please, Jay. So here's an example of that calculation. I used Apple, and you can see here, this is just taken from Yahoo Finance. The current share price, I did this, I think, on December the 5th. It was $265.58. And analysts were estimating that next year in 2021, Apple would make $14.86 a share. And that's an average. So you have the high estimate, you have the low, and then you have an average of those, of the high and low. So the 1486 is just the average of the two, the high and the low. Okay, and you also get the number of analysts and last year's earnings per share just to compare. So a year ago EPS was 13, and they're projecting next year it's going to be 1486. So if you go to the next slide, Jay. So you can see here again, this is taken from Yahoo Finance, and I just did the calculation. 265.58, which is the price, divided by the next year's estimate for earnings, gives you 1787, which is exactly what they're showing as forward PE. So that's how the number is calculated, and it is based on the current stock price. And then the average expectation of a group of analysts, or sometimes if the company has provided guidance, they'll use that. And you can see on this page from Yahoo as well, they're showing the trailing PE. So you get both. Okay, next slide, please. So this is just showing the earnings estimate from. Sorry.
I think it's nice to know, though, too, when you compare trailing and forward, if the forward PE is estimated to be lower than the past PE, that means the earnings are growing up. That's just a little. Sorry, go ahead.
Yeah, no, that's
the forward PE is smaller. That's a good sign, because that means the earnings are growing up. Going up. Yeah. Okay. Yeah. I'm sorry, Rob, but go ahead. Yeah.
No, that's fine. Anybody wants to jump in, just please do. So I just wanted to show this to highlight a couple of points here. So this is just for the last 5 years, and it's showing both the forward at the time, the 2-year forward earnings per share, and then the actual. and then I took the difference, which is delta on the left-hand side. So for example, in 2015, the forward was $6.77. The actual was $9.22. So they beat by 245, which is 36 and 19%. And so that's a big sort of difference between what the analysts were expecting and what Apple actually reported. If you look at the rest of the years from 2016 to 19, they're all within 20%. And so, the difference is 20%. And so when you look at the estimates, the earnings estimates, especially when we're doing SSGs, as long as it's kind of, there's probably a variability there of about 20%. So not to take that number as sort of gospel, but understand that there's some fluctuation. And these 2-year forward data you can usually find on Yahoo or Zacks. Zacks has quite a number of has pretty good estimates. So the main point here is that again there's a range, and as long as it's within 20%, that's okay. The other thing to note is you can see how analysts have been. If you go back, and look at this type of data, you can see where, are they always overestimating or underestimating, and that might help in evaluating the numbers that they're projecting for the coming year. The other thing to note with these estimates for earnings is that, again, a lot of companies are using non-GAAP numbers, and so it's really important not just to go on Yahoo Finance and pick up a number, but to look at maybe the 10Q or the 10K and see what they're saying about the earnings. Are they GAAP, non-GAAP? What are some of the adjustments that they're making, and take that into account. Okay, next slide, please. So what does the PE ratio really mean? So I came up with this little example. It's pretty simplistic, but I think it helps to understand it. So it helps us understand how much it'll cost to buy a portion of the company's profit. So if a PE ratio is 25, and that means it'll cost $25 basically for each dollar of earnings. So how much are we paying for $1 of earnings? So take an example. We want to buy this hot dog stand, and the owner says, I'll sell it to you for $12,000. And you look at the numbers, and he's making $2,000 profit. So in order to break even, like your PE ratio is 12,000 divided by 2, which is the price divided by the earnings, which is 6. So it'll take 6 years of making $2,000 to get that the 12,000 back. And if we could double the profit, so say that we figured, okay, this guy's not doing a very good job advertising or something, maybe we can get $4,000 instead of 2. So it would take 3 years to pay back that 12. So really what that, again, it's a multiple that's telling us kind of return on investment, or how long it'll take to recoup our investment. The opposite of the PE ratio, the inverse, is called the earnings yield. So if you take the same example here, PE of 6, and you invert that, so 1/6, 17%, and in the other case, the PE is 3, and so that's 1/3, which is 33%. So basically what that means is that in the first case, we're making 17% on our investment, and in the second, we're making 33. So you can take the inverse, the earnings yield, the inverse of PE, compare it to, say, to a bond, either a corporate bond or a government bond, and look at the amount of risk that comes with investing in that business, and compare that to a relatively safe investment of say a government bond, let's say a 10-year or something for the same time period, and see if you're being rewarded or compensated for the risk. So that's just another way of looking at the PE ratio by taking the inverse and looking at the yield. Any questions so far or comments? Clear as mud. Okay. So next slide, please. So what's a good PE ratio? And I can read this slide, but basically, if high PE ratio means that there's expectation that you know, the company is going to be growing, it's going to be successful, there's going to be a strong demand for that stock, which pushes price up, and that's why people are you know, willing to pay a high price because they expect earnings to go up in the future and the company to be successful. If the company, so that's a growth stock, and you know, if the company doesn't realize, you know, those expectations, then investors can get very upset and they can start selling, and the price can drop quite dramatically. So you have to be careful about that, and I'll show you an example in a second. And the opposite for low PE, but you know, there's two cases. You can have negative, so like a value trap where the PE is low, but the company really, or the industry, doesn't have a good future, and that's why the you know, the price is low because of those negative expectations going forward. Or people just could be not aware that, you know, of the company or their business, and no one is buying the stock. And if you dig into the you know, the financials, you can find that maybe it's it has very good numbers, it's operating quite well, it has a good future, but the rest of the street just hasn't caught on to it. So that would be a value stock, and that's basically, you know, what Warren Buffett and other value investors try to do. So there's really no such thing as a good PE ratio for all companies, and in order to use the ratio in any sort of meaningful way, it's important to compare one company with similar companies, competitors in the same industry. And then you can kind of gauge whether or not it's a high PE or low PE, whether you're paying a lot for those earnings or not when you're comparing companies within the same industry. Comparing companies that are in different industries and trying to make some sort of judgment on whether the PE is high or low is not it's not really very valid. And so it's critical to do these industry studies like we talked about, because you can compare two different PEs and gauge based on similar businesses. So next slide. Again, you know, we talk about high and low PE, but so here are the FAANG stocks, and so they're on this chart. It's a bit busy, I apologize, but you can see each line represents a different company. So the solid blue is Google, the orange dash line is Facebook, the red dash is Netflix, and so on. And on the right-hand side, you have different scales because the PEs of these companies are quite different. So on the bottom, you have the various quarters, and then on the right-hand side, the PE for each of the companies. And you can see if we were having a discussion in 2006 and somebody suggested that, you know, what is the blue one is Apple, I think, the gray, it's kind of a grayish thing, PE of 35, and Google had a PE of somewhere around 50 something, or in 2012 we were talking about Amazon having a PE of 3,500 I don't think any of us would have bought those companies. And you know, so you can see that you know, you can get some pretty ridiculous high PEs for, you know, growth stocks. Now the next slide, Jay, when you go to the next slide, just do one mouse click at a time. So you can see on this slide what I did was I said, what if we had invested $10,000 initial investment in each of these companies, and starting in 2006. The only exception is that in 2006 Facebook wasn't a public company, so it's actually I think they IPO'd in sometime in 2012, 2013 timeframe. At the time, they were $26 or $29.60, and the PE was started at 1,279, and it went down that year to 93. So still pretty stratospheric. And the rest of them, you can see the starting PE ratio in 2006 in December, pretty high for all of them. The exception maybe being Apple at 27 was kind of seemed to be more reasonable. So if you can click once, please, Jay.
Okay. Oh, sorry. I cannot click once. Oh. Okay, once.
Okay,
There you go.
tricky. So, okay, so if you had invested $10,000 in Google in 2006, today you would have made $63,000, roughly $64,000, annualized rate of return of 14%. Next one, Facebook. Now, keeping in mind that it's not the same time period because the IPO was in, like I said, 2012, 2013, but from 2013 till 2019, 6 or 7 years, you'd have made 28%, 29% annualized, and that 10,000 would be now 67,000. Next click. Apple, over the, whatever that is, what is that, 13-year period, I guess. 27% annualized, same as Facebook, but because you had a longer time frame, 10,000 would be $250,000 roughly. Next, Amazon, almost $500,000, 34% annualized from 2006, and finally Netflix, 800,000. So pretty dramatic. Now, like I said, I think if we were in 2006 and we were having doing an SSG of these companies, I'm not sure how many we would have bought at those PE ratios. The other thing is, you know, are they comparing, you know, PEs, are they in the same business? Well, you could argue maybe that, I don't know, Facebook and Google are in the same business. They're kind of internet, they monetize advertising. Netflix certainly isn't, Amazon is not, and they're a retailer. Apple is a bit of a retailer. So you could say Apple and Netflix are kind of, or sorry, Apple and Amazon are somewhat similar, but not really. So comparing those PEs doesn't tell you very much if you're looking at the FAANG stocks as a group and trying to, unless maybe it's Google and Facebook. So again, the point being, you kind of have to look at the company and look at similar competitors, and then look at the growth story. And, you know, because if you go strictly on PE, you wouldn't invest in any of these. You know, Buffett recently bought Amazon I think last year or something like that, or one of his lieutenants did. But that's certainly, it's not a value stock. So just, I think it highlights. So a few shortcomings. Okay, yeah, next slide, it's fine. So the one, yeah, that's fine. So some of the issues, the PE ratio doesn't really consider the outlook for the company, the growth, and that's what Bernard is about to talk about. And you have to be careful with the earnings. It could be, you know, the GAAP versus non-GAAP. As Tom mentioned, share buybacks can inflate the earnings because the denominator in EPS is getting smaller. And I missed a word there. It should say difficult to compare companies in different different industries. So next click, please. Oops.
Oh, I'm sorry.
Yeah, that's okay. Yep.
Okay.
So some alternatives to the PE ratio are the PEG ratio, which I'll hand over to Bernard in 1 second. And then there's 3 other ones: price to free cash flow, market cap to GGP, and then cyclically adjusted PE ratio, which also known as the Shiller PE or our Cape PE. So I'll mention those very briefly, but next slide, I'll hand it over to Bernard.
Just can you recap a gap versus non-gap in terms of a concept?
Sorry, which one?
Gap versus non-gap, the definition of a gap and non-gap.
Oh, gap and non-gap. Okay. So gap is generally accepted accounting practice, and non-gap companies will say they made an acquisition 1 year. They might say, okay, well, you know, our earnings were impacted because we bought this company. So what, you know, but we expect that after buying the, you know, that company, making that acquisition, things after a year or 2, things will return back to normal. So what would our earnings have been had we not made that acquisition compared to last year? Because people say, okay, the acquisition is a one-time event. We want to kind of compare their performance without these perturbations or disturbances. So that's where the non-gap comes in. There's certain sort of one-time items. If there was, say, I don't know, a lawsuit or something, which cost the company a lot of money, and so they put that money back into the earnings and say, well, if we didn't have this event, we would have made this much, and compared to last year, we actually would have done, you know, 10% better or something like that. So they're justifying, you know, some one-time events for investors, and which is, but you know, if you look at it legally, according to GAAP, that's, you know, that's what happened in that year, is they made an acquisition, it hurt their earnings, and so you kind of have to, it's a judgment call.
Right. I remember Morningstar, which is better investing data, versus Value Line. One's using GAAP, one is using non-GAAP. I don't know which one's which. Do you remember?
Yeah, it was Value Line is using non-GAAP.
Okay, Value Line is non-GAAP.
Yeah.
Non-GAAP. Okay.
So that, like, non-GAAP is you know, like in some cases it makes sense to use non-GAAP, because you do, if you really believe the story that it's a one-time event and things will get back to normal, you want to see, okay, how did they run the company had this event not happened? So it does give some insight, but you know, you have to go into the details. I don't think you can sort of take it at face value. You need to listen to what management is saying and see if it makes sense. Okay, Bernard, I'll pass it over to you.
Okay, thank you, Haney. Yes, understanding the PE ratio is a good foundation for going into learning about the PEG ratio. With the PEG ratio, I want to mention one little thing about PE ratios, because there's a guy, David Dreeman. He wrote 3 books about PEG ratios, PE ratios, and he found that most of the time, the low PE stocks outperform the high PE stocks. And of course, that isn't always true, because sometimes growth is more in style than value. But anyhow, as far as PEs, there's some good research from David Dreeman about how low PE stocks are the best bet, typically. But then let me get into what I'm supposed to do is the PEG ratio. And all we're doing here, we're taking the PE and we're augmenting it with the growth, because important, you can't really evaluate this. It gives you a better evaluation of the stock if you not only know the price to the earnings, but you also know how fast the earnings are growing. And that's what the PEG ratio is designed to do, is to tell you relative to the PE, what the growth, how the company is growing. And since the PEG ratio considers profit growth in addition to price and earnings, it's a better indicator than the PE alone. To calculate the PEG ratio is very easy. You calculate the price earnings per share, and then you divide by the earnings per share growth, divide by the growth. Now, the growth can be measured multiple ways. Typically, they use 1, 3, or 5-year growth ratios, time frames. I like the way Yahoo Finance, they routinely use 5 years, letting you easily compare different companies. The PE is usually calculated for 1 year to give either a trailing PE or a forward PE. A trailing PE can give you a trailing PEG ratio. Well, we're not going, my notes are not coming up. I put in a report. All I see is example. Well, okay. The PE, okay. The degree to which the PEG ratio indicates an over or underpriced stock varies by industry and by company type. A broad rule of thumb, some investors feel that a PEG ratio below 1 is desirable. Peter Lynch, according to Peter Lynch, the company's PE and an expected growth should be equal. So a fairly valued company would support a PEG ratio of 1. A company with a PEG ratio that exceeds 1 is considered possibly overvalued, while the stock with a PEG ratio of less than 1 is considered undervalued. Since the PEG ratio considers profit growth in addition to price and earnings, it is a better indicator than the PE alone. It can help us to know if the stock is under or overvalued. And my notes don't show here on the well, we didn't navigate through my presentation, but anyhow, that is my present. I've delivered it orally, but you never did see it on the screen. Hello?
Yes. Is there another
Oh, I
slide?
guess I lost. I guess I lost my connection or something.
No, there's a dividend adjusted to rate PEG. Are you going to?
I never, that's not my, that's something from Haney. That's not from mine. My presentation was different. I presented just on the PEG. But
Jay, can you
dividend,
get to?
I wanted to keep it simple. I wanted to keep it simple, but it's.
Can you get to Bernard's? He sent.
This is Haney's presentation. That's fine. It's good. I mean, it's very good, but it's not my presentation.
Okay, no, Bernard, do you want me to show your screen? Should I make you a presenter? You have something
that'd
to
be
show
all right.
now.
But okay. Well, my presentation, which I sent in,
Yes,
and by
we
the
saw
way,
your
too,
notes.
when I look on the Google files, and I go under this educational topics, my file is not listed. I don't know, and I don't know how. Maybe that's something in the future we could have an educational topic, how to use Google files, because I have trouble finding things, and like this here presentation that I made, I never got to see it on the screen here, and plus it doesn't show up. I submitted it to everybody, but it doesn't show up in the educational topics. My presentation is not listed.
Is it on your
Even
screen
though
right now,
I thought,
Bernard?
Bernard, did you put it in?
no.
Did you put it in the? Did
Well,
you put it in the directory, or you just? You didn't.
I just sent it to you guys.
Oh, okay. You
I
just.
made a copy. I copied a blank from that directory, and then no, I didn't know. I don't. That's the thing. Haney, I don't know how
Okay.
to do
Okay.
things
Well,
with
it's not.
this
It's not.
Google Files.
I can put it in for you. That's not a problem.
Okay.
Okay,
So, Hanny, are you
thank you.
going to talk about
Yeah.
dividend? Okay,
So
sorry. Okay.
no problem. Just go back one.
Okay.
So if you look at this example
Sorry.
at the bottom,
Uh-huh.
which is just the PEG ratio, and basically, you know, PE divided by the forecasted earnings growth. So if you have earnings 1 year of say $2.24, and the following year it's $2.51, that's a growth rate of 12%. And the PE is 12, so just dividing one by the other, you get 1. Okay. If you go to the next slide, if you have dividends as well as earnings, then the PEG ratio doesn't take the dividends into account. So a dividend adjusted PEG, you simply would add, again, if you had say a growth rate of earnings growth of 8% per year and a dividend of 4%, you would just add the two, and then you divide the PE by the sum of the 8 and the 4, so you get a slightly smaller PEG ratio, which is desirable, as Bernard was saying. So all you have to do is just add the dividend to the earnings, and that gives you the dividend adjusted PEG. Okay, next slide. This this other metric is called the market cap to GDP. If you take the market cap of all of the stocks in the stock market, in the S&P 500 or the Dow Jones or what have you, and divide by the GDP of a country, you get this market cap to GDP ratio. So if you look at the blue line is the market cap of the U.S. stock market in total, and then the red line is the GDP over time, and the difference between those two, the space between them, is really the ratio. And you can see that, like in some cases, like right now, the blue line, which is the total market capitalization, is much higher than the GDP, probably around something like maybe 50% more. And so that gives you a sense that the market as a whole is overvalued. The value of the companies is more than all the goods and services that are being produced in the economy, which is, so people are bidding up the price of stocks, and the market as a whole is overvalued. So how do we make use of that? Well, you might want to think about maybe holding some cash in reserve, or not, maybe investing in something like bonds or what have you. That's not a good thing right now because bonds are paying almost nothing, but you know, it's a warning sign that the market is overvalued and there could be a pullback sometime in the future. So next slide. So this is something called the CAPE ratio, or cyclically adjusted PE ratio, and basically what it is, it's another way to look at the market as a whole. And this was developed by Robert Scheller, who was a Nobel Prize economist. And basically what he did was took the earnings for a company over the last 10 years and adjusted them for inflation. And so the PE that he came up with is the price, the current share price, divided by this inflation adjusted 10-year average. And again, that's really designed, the reason for doing this is because over a 10-year period, the market fluctuates up and down. There's cycles, economic cycles. And so this is just a way to kind of look at the, to take that cyclicality into account. Next slide. Okay, I'm missing one slide, but I am not sure where it went. Maybe I just forgot to put it in. There's a, let me just look at my thing very quickly. I apologize for that, but oh yeah, if you could you go to slide 12, Jay? I forgot to mention this because I
which one's 12?
Keep going back up. It'll say PE by industry.
Oh, okay.
Yeah, right here. So I just wanted to, so we were talking a lot about comparing companies within the same industry and looking at you know, does the PE, how are the PEs related between two companies and so on, or relative to that industry. And if you, I don't know if you can do it, but click on the thing that says industry PE ratios. I don't think it'll show up.
Address of this site not valid.
Yeah. So apologies.
Oh wait, hold on. You put in your local
Yeah, it's a local thing,
document.
but
I cannot do it.
okay. Let
Do
me
you want me to make you presenter?
Sure.
Okay.
Sorry for that. Can you see my screen?
Yes.
Okay, so if I click on that, hopefully the spreadsheet will come up. Takes a second or two. Or maybe not. It's doing something. Oh, here we go. Okay, so let me just go back up here and over here to the top. So this data set, there's a guy at New York's Stern School of Business called Aswath Damodaran, and he teaches valuation. And if you're interested in valuation, you can go on his website over here. There's a link, and he's got an entire course online that they teach at Stern. Quite extensive, actually, hours and hours of video. But you know, certain parts of it are, and it's all videos, and it's so he tapes all of his lectures. But there's a lot of data and exercises and so on that he uses in his class, and this is one of them. So this is basically, and this is all available free of charge on his website. But this is the PE ratios by industry, and I think he uses the value line definition of industries. And so you have let's take advertising because it's just the first one on the list here. So there's 48 firms that they're using, and they give you the current PE, the trailing PE, the forward PE, the market cap. Oops, what happened? By net income, which I don't know how useful that is. And then the other thing they give is the expected growth rate for the next 5 years for that industry, and the PEG ratio. So if you can use this information along with PEG ratio that you calculate or PE that you calculate for a particular company. The other interesting thing is, if you look at this link right here where it says companies in each industry, so if you look at advertising, there's 48 companies that they're using. If you click on that, it'll give you a list of all the companies in each of these industry sectors. And so a lot of times when we're doing SSGs, we have trouble with trying to find competitors, and so this is a good place. And again, this I think comes from Value Line, so it's pretty consistent with what we do. So I just thought this was an interesting resource to use when we do stock studies. Is if we're looking at, trying to do an industry study, this is a good place to look for competitors and also to look at some average PEs for the industry. So that's all I have.
Where is this? You mean,
So if you
where
see
is this? I don't. Where's the address?
what I'll do, Bernard, is I'll put this spreadsheet changes. They update it periodically. So, but I'll put a copy of it in that directory along with your presentation. And then if you open the spreadsheet and click on any of these links, you'll get all of the various data sets that they're using. So all of the data sets are in this data website. This is his home page. And then this is the companies in each industry. And here's some definitions of all these different variables that they use. And then you can also download from the data website, you can download this particular spreadsheet, and it goes on for quite a while here. There's quite a few industries, and then at the bottom it has the total market, and then the total market without financials, because financials tend to skew some of the data. So it's pretty handy. And again, you have the number of industries that they're using and so on. Some of these, like shipbuilding and marine, there's not a whole lot of companies in that sector. But when you look at REITs, there's 238 REITs, oil and gas and so on. So you can get a pretty good idea of some of the competitors and then the average PEs and so on. So I'll put this in the education directory under PE along with Bernard's presentation. Okay. Jay, did you want to take the presentation back, or?
No, whoever next is going to present.
Okay.
I think Tom's up next. If you want to go first, Tom, or I can
Okay.
go.
Can I ask a question real quick, Hanny?
Yeah, absolutely.
Okay, so do you see precious metals there? It's like fourth from the bottom.
69.
Yes. Yeah.
Okay. Current PE is 1350, trailing PE is 263.95, and then
Yes.
forward PE is 62.73. Why is that trailing PE 12 months? What is that?
I suspect that would be the price of gold, because gold went up dramatically, and a few other, like gold, silver, other precious metals, platinum, things like that. When gold goes up, all the related precious metals went up. So the earnings for those companies, they were probably, the price was going high. I'm guessing that would be my guess.
Okay. All right. Thanks.
Or conversely, the earnings could have fallen dramatically and the share price would have stayed around the same. That would raise the PE also.
Yeah.
Okay. I'm going to make Tom presenter since he's going to present annual report. Okay, Tom,
Okay.
are you ready? Okay, I'll make
Yes.
you presenter.
Okay, so let's see if we can move this thing over here to the middle. Can you all see that okay?
Yes.
A little bit small, but it's fine.
Just click the box at the top right, Tom, beside the X. Oh.
Next to it. Oh.
Right at the.
Well,
just click the box on the top. See where the X is on the top right? There's a little square right next to it. No.
I've already got it I zoomed in. I'm at 125%.
Oh, he's yeah.
Oh, okay.
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 Yeah.
Oh, this box?
No, not
that's,
that. The maximize
No,
box. I think you already.
right at the top.
who you mean? You
Yeah,
mean this
that
one
one.
here?
Yes.
Yeah.
Uh-huh.
Yeah.
Okay.
Okay, so this is my stock selection guide for Skyworks. And you can see that the company was growing much faster historically than it has the last 5 years or so. Sales and earnings have really flattened out. That I was a little surprised. I just took over the stock that, like it's showing, if you look at historical, the share growth is 15%, but if you do like the last 5 years, I mean, the earnings, the earnings are, the growth rate is dramatically less.
Wow.
And it's, of course, if we and that may not be quite fair there because I had a decrease in earnings this last year, but you can see that the sales growth has really flattened out, and so have the earnings. So, I'm not real positive on this stock. A couple things the reason sales and earnings went down last year is because of the ban on sales to Huawei. And I think Huawei was maybe like 10% of their sales or something like that. So that was a pretty dramatic hit. But they're not Huawei's. They're not going to be able to sell to Huawei next year either. So unless of course they change. So they're about 50% of their sales are to Apple, and I'd say about 2/3 to 3/4 of their sales are for communications, like for cell phones, and the other third, that's what analysts are pinning their hopes on, that the company will continue growing because they have all these other.
Wait, you were saying that Huawei is one of the customers?
Yeah, Huawei was one of their major customers.
Major. Okay, I remember when I owned Skyworks a few years ago. I don't remember Huawei. I remember Apple as something else. Apple and
Samsung probably.
Samsung. Yes, Samsung. Some
Yeah,
Android phone.
right.
Huawei
So
was not even. Do you know the percentage of how much market share for Huawei for this company?
I'm going to guess around 10%. I don't
Okay.
know exactly. It's somewhere in that range.
Okay. In your 10K report, you said the Apple is a 51%.
Yes.
So Android is another 50%. So then they divide. Okay.
Well, they
Divide
have they sell other products too. They have. I'm trying to find my. I had the company's.
Tom, do
yeah.
you think like one of the things I read about Skyworks is that they are big into 5G, and that's that's a coming sort of growth cycle is 5G. Do you think that they might benefit from that down the road?
Possibly that there's going to be competition, but it's possible. Like the analysts are predicting 6% sales growth uh, going forward. And here's, they have, most of their sales, I'm going to say, 2/3 to 3/4 is mobile, which would include the 5G, but also sell chips that go to all these other industries. And they're talking about 5G, talking about Internet of Things, and I don't really know how to evaluate something like that. It just, to me, it's kind of this something that's going to happen in the future. I mean, it's like the Jetsons or the whatever, you know. I don't know if we're ever going to get there. Supposedly, some of these other markets are maybe more sticky and less competitive than the cell phones. I mean, you know, these, you know, Apple and Samsung are so huge that they can really exert a lot of pricing pressure on the companies. I mean, you have to really get competitive with their chips.
Tom, can you speak like something wrong with your mic? It's getting hard to understand.
Can you hear me now?
Okay.
I'm speaking.
That's better.
These, you know, these other companies or these other industries that may not have to be quite so competitive, and also the technology may not be advancing quite so fast, so that the products are going to be more sticky than they are in the cell phone. But
well,
you know,
there's a couple of things like that that I have some personal experience with, and that's you know, in infrastructure. We're in our business, we're seeing a lot of municipalities that are investing in smart infrastructure, and coupled with 5G. So, you know, all sorts of things like smart street lighting and traffic lights, transportation, smarter transportation for routing of buses and subways and trains and that sort of thing. And all of that is going to be utilizing 5G because of the speed requirements and to make some of these decisions and so on. The other big area is autonomous vehicles, and you know, if you look at like a lot of the automotive manufacturers are starting to get pretty sophisticated with the software, and I think Skyworks is part of that. So maybe what we should do is just look at some of these in a bit more detail, like these sectors, and try to see how much of Skyworks' business is coming from these various sectors, and then, you know, maybe we can try to.
I looked. I wasn't really able to find that. I can look, but you know, I mean, they weren't really transparent about how much they were selling to these people. They just talked about, you know, the future's going to be rosy because we're involved in these markets, but they're not really. They only list, you know, somebody like Apple's the only company now that's over 10%. They list all these customers, but they say all these other people are less than 10%. And I don't know how to evaluate that.
Do they mention, like, do they have
Oh,
the industries that they sell to, or is it?
Well, here's the, you know, the markets, the industries that they say they're selling to, and then they talk about, but then this is what they're showing. You know, they sell this, you know, you know, what in the world is that?
Right.
This particular chip.
oh, I want to mention
For what it's used for.
a little thing.
But it's, you know, this is the way
I think that's something to do with the 5G. That was what Henny just talking about. Cellular for your car, for the automobile.
Well,
On a global basis. Anyhow, on CNBC today, they were talking about Skyworks, how it was hitting a new high because of their participation in the 5G products, in the 5G evolution. So Skyworks today hit a new high, and CNBC said it was because of their participation in 5G. That was today on the CNBC News, Comcast.
It looks like 103 today, yeah.
I have also, Tom, have you looked their presentation? Under investor, when I started to study this company, a lot of things I did not understand. So they have a PowerPoint for investors, you know, draw pictures and explain what they are, and I thought it was very helpful. Is this the investor? Is under investors? There's shareholder. They will have something to do set the PowerPoint or something presentation. They give investors.
I looked at their
Oh,
slides.
company presentation. There you go.
I looked at their slides and really, I couldn't
Still did not
believe
make any sense. Okay.
what
So 5G.
they talk. I mean, this is all this sort of blue sky stuff, but it doesn't really give any numbers. It
Okay.
isn't
See,
talking about
artificial intelligence, machine learning. Those are good stuff. Auto
what.
autonomy driving and smart cities. Okay, that's all the things that Kenny you were just talking about. Those are things that's upcoming.
It's great stuff, but how do we quantify that?
Sorry, I'm saying it again.
How do we quantify this information? I mean, how can So they're
How to
involved in.
quantify. Okay.
How do we know how much? How do we put numbers on that? How does that going to further earnings?
So to me, I'm looking at this to me. The 5G is the future, right? Upcoming future. And right now, or like last year, 2 years ago, we are talking about Internet of Things, right? You have a Google Home, you have like for me, my house, I have a smart lights, I have Nest. So, but the next thing is much smarter, the emerging using a 5G technology. So this just shows you what's going to happen, how uh, artificial intelligence is going to use Skyworks product. We don't know the technical detail of like you show early, like they have different kind of products, but at least that tells me that
So
the trend.
maybe I mean one way, and I mean you raise a valid point, Tom, is that you can talk about all this stuff, but how much are they actually going to get into it? How much market share and so on, which are all very valid points. So maybe one thing we can do is just if we contacted their investor relations department, I'm just wondering if they would give us a breakdown or give some sort of indication of which of these areas they're investing more in, or looking at their R&D budgets, and then we could it might be a couple of us might have to do this together because might be a bit of work, but
I can give them a call and see what they say, but I will bet that they'll tell me it's proprietary information.
yeah.
So in their 10K annual report, they have a presentation for their 10K. I'm just curious. I mean, sorry, yeah, 10K like a presentation talking about they are across markets, the market share, anything at all.
Well,
Maybe I can.
like I said, I read through it, and they talked about all the services that they're putting into, and they talked about all their customers, and if they're over 10% or under 10%. And all they said was Apple was over 10%, and everybody else was under 10%.
Yeah, they
Another
really.
said that it was 50, Apple was 51%. They didn't even say that. They just said over and under 10%.
Yeah, I'm looking at 10K. Yeah, they really did not have any presentations. They just have, yeah, basically just a 10K and with a cover.
Well, I think the 10% is it might be like a regulatory requirement if they have too much dependence on one customer, they have to identify that. So that's probably why they did that, but they're being probably coy about the other stuff. So
that would make sense to me, yes.
yeah.
Yeah.
Well, I think like from just I was just looking at the chart, and their chart looks it's gone up quite a bit in the last few months. The price has gone up. It had quite a spike. if the financials look okay, I mean, I agree with you. The sales numbers don't, you know, they flattened out over the last 5 years or so, but that was the same for the entire semiconductor industry. So
Well, here is Skyworks and its competitors. There's one called Corvo or something like that, which has been the best recently. And Skyworks is second. It's
Tom,
about 50% over the last year.
Tom, it's hard to understand you.
Well, I don't know what to tell you. I'm speaking right directly into my microphone.
That's better. That's better.
That's better.
That's much
Okay.
better.
Oh, that's much better now.
Okay, now I've got my headset on, but maybe the headset isn't working. But I'm putting my mouth here next to the computer.
it sounds like you're speaking through the computer, Tom. You have to go into if you go to webinar and then under audio, I think you can.
That will be testing next time. Let's text.
No,
test.
in addition, there's a little down arrow, and it'll ask you which if you're using the microphone or the headset.
Is this it here?
Can you say a few more words?
Is this where I should be looking?
Yes, better.
Where do I go?
Oh no, it's
Wait, can I?
I'll do it after. I'll do it with you after the meeting.
Okay. So I'm looking at geographic information. United States is the biggest revenue, and the next is China, and then South Korea, Taiwan, Europe, Middle East, Africa. That's very little, and then other Asia Pacific. China compared to last year was down.
Well, that's probably from Huawei. And
Yeah,
maybe
so does South Korea.
some other companies that are finding other sources because, you know, they aren't the only game in town. They've got competitors.
Yeah, only Taiwan slightly more than last year. South Korea also was down almost like 100 million, I think.
If you look at the chart there, Tom, that you're showing, it looks like all of them were pretty flat for the last several months since January or so, and you know, the entire semiconductor industry has been in a bit of a decline for a bit because they had oversupply, and then I think they're starting to come out of it. I don't know. I would just wait a bit and see what happens.
Mm.
Yeah, I don't think we necessarily need to bail out, but you know, Apple's, you know, we can see what happens in the future, but Apple's their biggest customer, and Apple's iPhone sales are pretty much flat or maybe in decline.
Oh, your microphone's much better, Tom.
Well, that's because I'm speaking in to the edge of the computer rather than into my headset.
Oh,
and
okay.
I think I've got the settings wrong here.
Yeah.
There's probably no point in me even wearing this headset, right?
Oh, okay. So I'm looking at they are annual report. They definitely stand out 5G. You know, they're talking about how 5G speeds will reach to 10 gigabyte, 100 times faster than the 4G. They talk, yeah. So I will say hold it. But I do have one question on your 10K report. You had a 10 years projection last SSG 10 years. You don't have you did not find the 5 years projection? Or it should be 5 years. You just put in the right.
Well, maybe I put it in the. I never did it. I don't know that I projected a 10-year. Where? Let's see here.
I'm just curious. I know I should give you that feedback when you submit the report, but.
No, I'm trying. I don't know which window. Here.
Yeah. See, you have last 5 year. You say, oh, sorry, last forecast 10%. Should this be a 5 year?
Well, that was
SSG.
that was the last SSG. That was the. Maybe I put it in the wrong box, but the other Roy's SSG said 10% and 10%, as far
Okay.
as sales and earnings.
Okay.
And I changed it to 6% for sales, and then I did preferred procedure, and I came up with 8.1.
I think the forecast has been next 5 years, so it's just
Well,
should be
okay, so I put it in the wrong box.
okay. That's okay.
So that's
Another thing is, when did we purchase? How do I look at the iClub to figure out when did we purchase Skyworks? Because Tom had it was just by mistake. It says November 2019. I think that was just mistake, typo probably. I tried to look on the iClub. I don't know how to find when we bought.
I can do that with you maybe
Oh,
after, just
okay.
so we
Okay.
don't go too much over here. So because we're
Yes.
getting short on time, so
Yes.
It's
Okay.
almost 7:30.
Yeah.
it's
Okay.
10:30 where I am.
Oh,
Yeah.
okay, that's true. Well, but we've got 30 minutes.
It's past my bedtime. No, I'm just joking. Okay. Next one is Matt.
So who? Matt?
Next.
Okay.
Is it Matt? Matt? Okay. I forgot who's on the.
So we're not
You see the
following.
screen?
Matt sent out an agenda, but we're not following it.
Oh, who's next? I'm sorry. I did not know
No,
who's on
that's
the.
what I was asking. I was asking Matt.
It's a Matt, Disney. Yeah. It is on the
Yeah, it's
agenda.
Disney.
Disney. That's right. Go ahead.
Okay. Are we ready? Yeah.
Yes.
So if you see the agenda, Skyworks. So we did that, and then Disney,
Mm.
and then we did PE and the PEG ratios. So we're a little behind, but as long as we finish by 7:45, that's when we really have to discuss any buy and sell actions. So, and if there's time, we'll do AQN. So I'll try to be as brief as possible given the time. Okay.
Okay.
So going back to the report, yeah. So Disney, I'll be really quick through this part. So closing price today was 146. 52-week low was 100, and the high was around $153 per share. Current PE ratio is 22.9. It's the price is pretty high as of late, and the average PE ratio over the last 5 years was just under 18, 17.8. The average high was 20.8, and the average low was 14.9. So over history, the PE ratio is pretty high currently. It's pretty high. I guess just looking at their current results from the most recent 10K, the revenue is increasing pretty nicely, and most of that's due to the acquisition of the 21st century now, whichever one we're in, Fox acquisition. So 33.5% growth just from the acquisition of Fox, and that's kind of the big news lately for them. So that closed in I wrote it down here in the notes, fully in the third quarter, or their third quarter, which was the prior quarter to this one that just closed. Sorry, I'm going to skip ahead a little bit in the report here. So
could you make it a little bit larger?
Oh yeah, sure. Sorry. Is that better for you, Bernard?
Yeah, a little better. Yes, thank you. A little better.
How about that?
Okay. That's yeah, good. The better, the bigger. Yeah. Okay. Thank you. Thanks, Matt.
The rumors are true.
Oh, that's much better. Yeah.
Perfect. So, yeah, so they had really high, I guess I'm just going to skip to the main story for Disney. It is all about streaming lately. So the stock had a major increase as a result of the direct-to-consumer business, which is, Hulu, Disney Plus, and ESPN Plus right now for them. So the major story, at least for the stock, is really all about 2020 and the future of kind of direct to consumer. So the major news lately is Disney Plus went live, I think, I guess, on mid-November, I suppose, in the U.S. And it's slowly going live in other countries. And the big story was that I think 10 million people or something signed up for Disney Plus on the first day or something like that. So just wild adoption rates. And they were, doing all kinds of things, kind of giving it away for free for the first year to a lot of people and all kinds of things in the U.S. So I guess, they're having great growth or adoption rates initially for Disney Plus. And that's really where, kind of why the stock went up so much. Excuse me. So really, sorry, I'm a little off from here. So initially, at least in earnings wise, anyhow, the direct to consumer was really kind of bad as they're figuring out, they're kind of doing some work at Hulu and getting all of their ducks in a row, I guess, if you will. So if I kind of skip through my report here, the highlight, I suppose, in the big news anyway, is the launch of Disney Plus. So they signed up 10 million on the first day, which I put here. Sorry that I'm reading through. And they expect in total for Disney Plus to reach 60 to 90 million. So on the first day, they got roughly 20% of what they expect the total to be by 2024. So kind of modeling it out, I guess I just wanted to highlight that really quickly. So you can see what I did here is kind of their low estimate for ESPN and Hulu is here. Sorry, this first table does the estimates for ESPN, Hulu, and Disney Plus. This is the low estimate here in this first table, and this is the high estimate kind of down here in number of users per year. So they have said that they expect the users for ESPN Plus to reach between 8 and 12 million. What I wrote here in their news and information. Back to this chart. They expect it to reach between 8 and 12 million for ESPN Plus. 8 here and 12 here. 40 to 60 million for Hulu. 40 to 60. And 60 to 90 million for Disney Plus. Oh, there it is. I wrote it there. And the monthly price for each of those is $7.99. At least current monthly price, just advertised, is $7.99 for ESPN, $5.99 per month for Hulu, and $6.99 per month for Disney Plus. So if you take those monthly prices and the expected number of users, the 8 to 12, 40 to 60 is 60 to 90. And you look at kind of the current users of those services, which are 3.5 million, roughly 30 million at the current, and 0 as of a few weeks ago, anyways, for Disney, or at the end of the earnings or the end of their fiscal year. And you look at what the potential growth could be based on those 8 to 12, 40 to 60, and 60 to 90, and the current users of 3.5, 30, and 0. So you get kind of this per year user growth range of 0.9 to 1.7 per year if it's kind of a straight line from now until 2024. And basically you get 0.9 to 1.7 for ESPN Plus, 2.2 to 6 million users per year for Hulu, and 12 to 18 million users per year for Disney Plus at these prices of $7.99 per month per user, $5.99 per month per user for Hulu, and $6.99 per month per user for Disney Plus. So that range of users per year equates to this green table in revenue per year. So I tried to kind of model that out, which is roughly 1.2 billion in this chart to $2.1 billion per year from now until 2024 in just streaming. So that gives us roughly $6 to $10 billion in just streaming growth, $6 to $10 billion growth on top of their current revenue at the end of the fiscal year, which was roughly $70 billion, which you can see here. So yeah, a lot of the growth in Disney, if it's $70 billion, they're estimating it, the streaming growth to be $6 to $10 billion, which I wrote
Matt, would you
over here.
on your spreadsheet, would you not, because you have the same numbers going all the way across, would you not do incremental? So like you have the, take the, I don't know, ESPN, so it's 86 million in the first year and then 86 in the second. That's incremental, right?
Yeah, that's incremental. So I'm basically trying to, go ahead.
Would you not just add it and then you end up with your total at the end to show like you could actually have a graph, right, of you know what I mean? Like instead of 86 each year, you would add the 86 to the previous years, right? Does that make sense?
Right. So like the cumulative.
Yeah. Is that what that means, or am I interpreting that correctly, or?
Yeah. So at the end of 5 years, it's 430 million.
Right. Okay.
Is that right? I feel like I'm more than that. 86.
Is that roughly what you're asking, Katie?
Yeah, like so in 2021, it wouldn't be 86, it would be 172, which is 86 plus 86.
In total, right? Yeah. So I'm showing just the incremental for each of the years, 2020, 2021,
You're keeping
2022.
So it's a pretty steady.
I'm just estimating. So they said roughly that they think there will be 8 to 12 million new users for ESPN Plus by 2024.
The other thing
is their statement.
The other thing is I don't think that they would keep their monthly price the same for that many years. It would be nice if they did, but I have a feeling.
Well, they may. I'm giving them the benefit of the doubt here and kind of, using the conservatism principle. But yeah, no, I totally agree. So like this is base case, right? That will definitely go up. So all I'm trying to do is estimate, kind of what the base revenue growth would be just from streaming. So the moral of the story is when you do all this spreadsheet stuff, that this streaming alone, so sorry, I'm trying to scroll here, amounts to 1.7 to 3% revenue growth if all of these assumptions hold true. So what they told us, first off, which was 8 to 12 million ESPN Plus users by 2024, 40 to 60 million Hulu users by 2024, and 60 to 90 million Disney Plus users by 2024. So if that comes true, and these prices hold, then that will give them roughly 1.7 to 3% revenue growth, just from streaming. So, and if we relate that to the SSG, I have estimated 6% sales growth, or what was estimated that I left on the SSG, 6.2% sales growth. So roughly what I'm saying is, or what we're saying currently, is that 6.2% sales growth, roughly half of it is going to come from streaming over the next 5 years. So this being, the first quarter that I'm following Disney, and it being the annual report, I may revise that, I guess, or at least what I'm setting up for is to revise it higher in the future. And it seems like a lot of people were excited when, so many people signed up and all those kinds of things, given, the streaming. So I guess what I'm saying is I'm going to watch over the coming quarters for Disney what streaming is kind of looking like, and over the next quarter, their next quarterly report, what that subscriber growth is, because it seems like that's what's really driving the stock.
Well, in addition to that, I think, if you look at Netflix, they don't have the library that Disney has, so they have to spend a lot of money to create content to compete with Disney, whereas Disney's kind of recycling a lot of their old movies and that sort of. They have a few new things, but a lot of it is their old stuff. So their cost to produce that their cost to get all of that new streaming revenue is not going to be as much as their competitors, right? I think.
So what's the difference between Hulu and Disney Plus?
Netflix has the lowest discontinuing ratio of anybody. There's 7% of the Netflix customers discontinue every year. Every other streaming service has higher rates of customer dropout. Netflix, it's true they have spent a lot of money for content, but they have the lowest dropout rate of any of the streaming services. Netflix.
I didn't know that. That's a good point. But, because they have really good content, but I was just wondering how much they're going to pay to keep sort of producing those shows. But they're doing some creative things, Netflix. They're, they're trying to get their stuff in movies. They're trying to win Oscars and Golden Globes and things like that to generate interest in their content, which is a smart strategy. But I think if we're gonna, watching Disney, I think we should be looking at some of the competitors like Netflix and I don't know if Apple or Prime Video, who would be the next one. But I think we shouldn't look at these things in isolation. We should look at it as an industry and compare it to their competitors and see how they're doing.
Which I think is Comcast, right? Which we at least for content wise.
Yeah. What's the difference between Hulu and Disney Plus?
The difference is mainly the content on Hulu versus Disney Plus. So Disney Plus, I haven't downloaded it yet, but I forget how many thousands of different shows they have just immediately available. But it's basically the Disney library on Disney Plus,
Hulu.
available online. And Hulu, I don't watch Hulu either, to be fair.
Live
I
TV,
don't know
live
what's
TV.
on there.
Okay, I know. I was just
Hulu has
curious.
sports. I've seen the commercial. That's basically what I know.
Okay, so they do live TVs. Okay. Okay, I'm just
Yeah, Hulu's
curious
kind of a
because
minor
what's the
player in
yeah.
streaming. Yeah.
Uh-huh. I try to understand what's the difference between like why do I use Hulu not Netflix? But Netflix doesn't have a live TV, right? So, but try to understand.
Well, they just
Oh, maybe
showed
live.
different shows.
Well, I can tell you because a few months ago I bought a Tesla Model 3, and in the software, the latest software update that I got, Tesla has Netflix and YouTube. So when you're charging your car on a long trip or something, you can actually watch Netflix. So they made some sort of deal with Netflix. I don't know if they'll make similar deals with the other streaming services, but so Netflix seems to be using different channels to get their content out, whether it's in the home or in the car and in the movie theaters. So that's interesting.
For television, the largest seller of television ads in the world is Comcast. That's not streaming, but that's TV ads. The largest seller in the United States, and I assume the world, is Comcast. They
So
sell a lot of TV ads.
how close to buy for Disney? Matt?
So the buy range, I believe,
Yeah.
is around 140. Yeah. Buy zone is 139.80, and it closed today at 146 and change.
Okay.
So we're really close, but it's not, extremely compelling return. So this is with refreshed. I think it's with refreshed data. Let me try one more time. Disney will overwrite.
Well, it's a mega company. It's hard to.
It is a mega, yeah.
Yeah, it's hard to.
You know what? This 147, it hasn't updated the closing price, but yeah. I guess the main thing is, the return is pretty low with the average PE at 3.7 and the high 6.9%.
We also have a Comcast too, right?
That's sort of like Comcast, not very high return. Yeah.
Right.
Is Comcast really direct competitor of a Disney?
Sort of, yes.
Oh yeah.
But then why do we want to have it both?
Similarities.
I'm just curious.
I think we originally bought both. Because at the time, Comcast was also bidding for 21st Century Fox. And we weren't sure who was actually going to win, the bidding war.
Okay.
If I remember correctly. But in the end, Disney won. And they acquired all the 21st Century Fox assets, which are the main thing, at least lately, is the Marvel universe. So all the Marvel movies that are, coming out, like X-Men and Deadpool, I think, is one in the Marvel universe. And I think each movie roughly does, $500 million to $1 billion in box office revenue. So, yeah.
Okay.
But that's why we have both. So, or why we bought both initially.
You would have a Disney for a while.
What's that?
In one Super Bowl, Comcast will sell $1.6 billion in ads. I'm not saying that
Wow.
it's a buy or anything, but it has strengths too. They both have strengths.
Yeah,
Mm.
definitely.
But
I think they're both holds, or at least Disney is a hold for me right now. But the future is positive, so I think for future quarters, I'm definitely watching. I own Disney personally, so I'm excited to start watching it now. But I do think the price is a little high, and I kind of want to see where all this streaming goes. So 10 million subscribers on day one is super exciting, but I think a lot of those are free trials and so forth. So we kind of just want to see, I think, at least personally, where this whole thing kind of shakes out. So Disney is expected to be the big streaming player going forward because, they own ESPN, ABC, all this movie content. They own Hulu now, which has, the roughly 30 million subscribers. So when all of that kind of works itself out, where, how much revenue is that really worth? And what's that do to the stock? So still a hold, but definitely watching to buy more soon. So with that, that's my report. Going to the agenda, I believe it's here.
by the way,
It seems we don't have
we don't
time to
follow
go over
the agenda.
AQN.
I printed.
Mm-hmm.
Yeah, we don't follow the agenda. That's everything has been different than what's on the agenda. The
What
order
do
is
you mean?
different. The
It
things
is?
are different. Well, like for example, it says for education topic, my club, my iClub, and PE. Well, we covered PE and PEG ratios, but we didn't cover my club.
My
And we
club is
didn't cover
that was fun.
ALQ.
I
That
think
was what?
we modified at the beginning. My club was last month and it was a mistake. So at the beginning meeting, we erased my club.
Oh, it was.
Jay,
Sorry
I'm
about
looking
that.
at December 9 agenda, and it said my iClub would be on the education topic. But anyhow, I thought it was very nice. Matt Claiborne sent out the education. I printed it out because I like to follow it, but
I know.
we
But
didn't follow it very close.
you printed out the one is not the latest version, Bernard. We modified 5 minutes. I don't know, 5:30. We modified the education topic. My iClub was the last month, and so Henny asked me to delete
Well,
that, so I did.
Sorry, my mistake on that.
December 9.
Okay. Let's see, we have like 8 minutes or 7 minutes before the meeting's over. Are there any recommendations or motions?
Nothing a buy, though.
No, I think everything was a hold, so
Mm.
I personally don't have any.
At some point, I want to discuss my concerns about that we don't discuss holds.
Right now.
Yeah.
Yeah, 5 minutes. Go for it.
No, because I think some people are the way they're handling their SSGs may need some assistance, and I would like to be offering that help before they get to the annual report and they have to show their annual report. So if there's anybody that wants to show their SSG, even though it's a hold, I think they should be able to.
You mean referring quarterly or annually?
Quarterly reports, because annually
Quarterly.
they have to show their
I have to show, yes.
but we're not requiring quarterly reports if it's a hold. But for instance, I looked at Bernard's, I thought it was in a buy. I thought John's was in a buy. I thought Hanny's was in a buy. And I just want to know how they came up with their numbers and their, so.
So my
I would be
SSG.
glad to go through it. I'm doing the best I can, but I'm not a
I
real.
know, Bernard, I'm not
There's
saying.
things I need to learn more. I need to learn more.
Exactly. I totally agree. That's why I'm thinking that we need to have people show their quarterly reports. And it can be, I guess it could be optional if it's a hold, but if we can offer assistance, I'd like to be able to do that.
Okay.
So if I could,
I send it.
sorry, Bernard, excuse me for a sec. I think the main reason we were running out of time on the meetings, so we decided if we didn't need to make a decision, then we would just not present holds. But I understand the point. It's a valid point in that, you know, someone may have a different view of the stock or the interpretation of the SSG. What we might want to do is just maybe have people that are not as familiar with the SSG to work with somebody before the meeting and to have them maybe vet their analysis. Would that sort of solve that problem?
Joanne is saying is that the SSG showing a buy, but the on the report final presentation says a hold, right, Joanne? You are saying that
That also, that as well as when I look at the numbers where people are getting their numbers, they're not making sense to me. So I don't know, you know, I want to know what their process is.
I think like a circumstance like this, we should, that person, that stalker follower should present a report and SSG to justify why. For example, like a Facebook, just example is Facebook as a buy, but Jane says a hold because we have a large, you know, we have large holdings, right? So just as a one example.
But it could be an opportunity for somebody to buy that's in the club that hasn't purchased it yet. So I'd still like, okay.
But when you read my report, you will see why I suggest to hold instead of buying more, because we have a big position.
Yes.
We need to balance. But if you read the report, then you know the reason.
Yeah, but also Joanne's point, I think also not just that, she questioning some of the judgments,
Correct.
forecasts, projections.
Yeah, but I think the most important thing is somebody to work with some clubbers who are not as experienced. That's important, because if you have them present and then you raise question, then you will not help them because you will intimidate them.
I guess we can.
I agree. I think that's. I think the idea is to, you know, is to get a second opinion on how people are doing SSG if they're not maybe as experienced or comfortable with it. So that's better done one-on-one, where you have more time to discuss and so on and explain.
Although I think it is beneficial in a group setting that when we go over something that's could be helpful for other people that aren't necessarily.
It's true, but it's a balance because we were running out of time in the meeting.
I know. I understand.
Yeah.
So, but if there's an opportunity
we can pair some more experienced clubbers with less experienced clubbers, and then if they both have the same recommendation, then we can still ask them to present if you think it's worthwhile to see how their thinking process goes.
Oh, another thing is just following our current reviewing process. Like, for example, Joanne reviewed the Comcast and say, hey, I question Comcast, you know, why it's not a buy. Oh, it shows buy, but why is hold? So then at the meeting, we can make Comcast as presenting.
My report did not show buy. My report did not show buy.
Oh, well, just as example, not necessarily. I'm just saying using Comcast as example, because Joanne questioned the Comcast in her email, right? So case like this, maybe we can present the questioning ones, and so everybody can learn from.
Yeah, sure.
If we have time.
If we have
time.
All
right, we have a minute left in the meeting, so I guess there's no motions for a buy, and Tom and I will be doing this stock study for next month.
Yep.
So I think that's it.
Do we have a sell? No sell.
But you know,
no motion.
I never did get to see my report, but that's okay.
Okay.
We
you know, Bernard, we can close the meeting
my report,
and then we can discuss it. do you want to adjourn the meeting,
Yeah.
Penny, and then we can help Bernard?
All right. Yeah.
Sure. Yeah.
Okay.
So Jay, can you, because I don't have access to the,
Oh, stop recording. Okay, and then we go open
yeah.
mic.